If you're paying 24% interest on credit cards, you're basically lighting $2,400 on fire every year for every $10,000 that you owe. Not a fun bonfire, and unlike a real bonfire, you can't even roast marshmallows. But plot twist, a personal loan could cut that rate in half. So in this video, I'll break down what a personal loan is, how they work, the requirements to qualify, and the mistake that turns debt consolidation into debt multiplication. I'm Alex Gettlin with Achieve Personal Loans. We've helped thousands of people consolidate high-interest debt into one manageable payment. And we're ranked top 3 in customer satisfaction in home equity by LendingTree for a reason, because we treat you like a human, not a spreadsheet. Let's get into it. So what even is a personal loan? It's actually really simple. It's basically when a bank takes a pile of money and deposits it straight into your bank account. It feels like an awesome Christmas gift, except you have to pay it back responsibly. Most have a fixed rate, meaning your payment stays the same every month, unlike your streaming subscriptions that can keep creeping up on you. You pick a term, usually 2 to 5 years, make your payments, and boom, you're done. Freedom. Let's say you've got $18,000 in debt spread across 4 credit cards at 24% interest, paying $540 a month in minimums. At that rate, 14 years to pay it off. 14 years. That's not a payoff plan. That's a subscription to suffering. That's why consolidating into one lower rate loan starts looking real attractive. You don't need perfect credit to meet personal loan requirements, but lenders care about these 3 things. And spoiler, your personality isn't one of them. Credit score. Most lenders want 620 and up, but some will work with 600. You don't need to be perfect, you just need to be functional. Steady income. Lenders want to know that you can make the payment. Shocking, right? They'll check your debt to income ratio. Reasonable debt load. Here's what people miss. If you're using the loan to pay off debt, lenders factor that in. They're looking at where you'll be after. They're not judging your past. They're looking at your post-consolidation future. Pro tip, check your rate with a soft pull first. Your score won't drop just for looking. If you're thinking about getting a personal loan, here are 3 good reasons that won't create trouble for you later. 1, lower rates. Credit cards charge 22 to 25% APR. Personal loans as low as 9%. On $18,000, that isn't just pocket change. That's, I can actually take a vacation instead of I'm dreaming about Cabo money. 2, predictable payment. No more juggling 4 cards with 4 due dates. 1 payment, same amount, same date, every month. Set it and forget it. Your anxiety will finally take a nap. 3, a clear payoff date. Personal loans have a set term, 2 to 5 years, and then you're done. Free. It's a beautiful thing. If you came into this video wondering if a personal loan could help with your credit card debt, now you know. You've got the requirements, the benefits, and the warnings. Bottom line, a personal loan is a lump sum with a fixed rate and fixed payments. If you're drowning in credit card debt, it could be your escape hatch. But escape hatches only work if you don't jump back into the fire. Want to see if you qualify? Achieve offers free consultations. No weird sales tactics. Links in the description. We're A+ Better Business Bureau rated and a 4.8 on Trustpilot. Subscribe for weekly debt strategies that actually make sense. See you in the next one.